Hello guys, welcome to the accounting class. In today's class, we are going to discuss GAAP, Generally Accepted Accounting Principles, SEC, Securities and Exchange Commission, IASB, International Accounting Standard Boards, IFRS, International Financial Reporting Standards, and Principles and Assumptions of Accounting, and finally the forms of business organization. So let us begin the video. First of all, we shall take the generally accepted accounting principles. What are these principles? Concepts and rules that govern the financial accounting is known as generally accepted accounting principles. So it is concepts and rules. According to these concepts and rules, we apply in the financial accounting and prepare the accounts. Generally accepted accounting principles make the information relevant, reliable and comparable. We have already discussed the meaning of relevant, reliable and comparable in my previous video. You can watch that. Now the next is SEC, Securities and Exchange Commission. This is an organization which is created in United States. The US Securities and Exchange Commission is a large independent agency of the United States federal government. So this is an independent agency which is created in the United States federal government aftermath of the Wall Street crash of 1929. In 1929 there was a Great Depression because of the crash of the Wall Street. The primary purpose of the SEC is to enforce the law against market manipulation. If there is any market manipulation, the law can be prepared in order to check the market manipulation, and the making law against market manipulation is the primary purpose of Securities and Exchange Commission. So in 1929 there was a Wall Street, it means there would have been some market manipulation, and after that there was a need to make such an act. Securities and Exchange Commission has the legal authority to set GAAP. So this commission will set GAAP, that is generally accepted accounting principles. SEC has delegated the task of setting US GAAP to the Financial Accounting Standard Board. So now see what is Financial Accounting Standard Board, because the task of setting GAAP was shifted from SEC to FASB. FASB is what? FASB is an independent private sector not for profit organization which was established in 1973 in Norwalk, Connecticut, USA. FASB established financial accounting and reporting standards for public and private companies and not for profit organizations that follow GAAP. So establishing the financial standard is the task of Financial Accounting Standard Board, and these standards are set for the public and private companies, for the not-profit organizations or any organization that follow the GAAP. Now the next body is IASB, International Accounting Standard Board. In short we call it IASB. It is an independent group of individuals and countries and established in 2001. IASB issues IFRS. IFRS means International Financial Reporting Standard. Now IFRS is being accepted and adopted by most of the companies of the world. Now come to the next point of our discussion, that is principles and assumptions of accounting. So let us see what are principles. Accounting principles are the basic rules that define the parameters and constants within which the accounting operates. So this is a parameter and the contents or the body and the limitations within which the accounting will operate. So we don't have to cross the limits prescribed by the accounting principles. We have to be within the limit. We have to follow those principles whenever we are making the accounts. Accounting principles and assumptions are of two types. First one is the general principles and assumptions, and second is the specific principles. General principles and general assumptions are the basic assumptions, concepts and guidelines, whereas specific principles are the detailed rules used in the reporting business transactions. General principles and assumptions, let us see, there are 4 general principles and 4 general assumptions. The 4 general principles are measurement or cost principle, revenue recognition principle, expense recognition principle and full disclosure principles. Whereas the general assumptions are going concern assumption, monetary unit assumption, time period assumption, business entity assumptions. Let us see the 4 general principles and the 4 assumptions in detail. The first principle is the measurement or cost principle. According to this principle, we record the actual cost of the business transactions. So the information prepared by the measurement or cost principle is based upon the actual data or actual cost. Let us understand with one example. Suppose a company pays 10,000 for purchase of an equipment. According to this principle, whenever you write the purchase of equipment, you will record 10,000 because 10,000 is the actual cost you have paid. But if the owner thinks that the machinery or the equipment that he has purchased for 10,000 has the value or the worth of 12,000 or whatever, it may be 15,000 or 13,000. So whatever he thinks is the value of the equipment, he cannot write that value. He has to write only that value which he has actually paid. So 10,000 is only recorded because of the cost principle. The next principle is the revenue recognition principle. This principle provides the guidelines or guidance on when a company must recognize revenue. When the revenue is recognized, the company will or the business will record the revenue. So what is the meaning of to recognize? To recognize the revenue means to record it. Revenue is recognized when earned. The earning process is normally complete when services are performed or the ownership of the products are transferred. So revenue is recognized when the revenue is earned. Now when the revenue is earned, the question is, so it is solved that the revenue is earned when the seller transferred the goods and performs the services. So at the time of transferring the goods means transferring the ownership, immediately the revenue is earned. Revenue earned and revenue receipts are the two different things. It is possible that the revenue is earned but revenue is not received. For example, in case of the credit sale, you will earn the revenue at the time of sale but you will not receive the revenue. You may receive the amount later on, but immediately since you have delivered the goods, so revenue will be recognized, and when the revenue is recognized, you should consider it and you should record it in the books of accounts. The next is the expense recognition. It is also called the matching principles. According to this principle, expenses are recognized when they match with the revenue. So we take one period. For that period of accounting, we should see that whether the expenses are matching to the revenue with that period or not. Matching principle is used to make the adjustments of outstanding expenses, prepaid expenses, accrued income and unearned income. These are the four adjustments that are made because of the matching principle or expense recognition principle. The meaning of expense recognition is that you should consider the amount spent as expense when it is capable of generating the revenue. Suppose you have spent an amount, but the benefit of your expenditure you are going to get in the next year. So the amount spent now will not be considered the expense because the benefit you are going to get next year. So the next year when you will get the revenue, then you should consider the amount spent as the expense. Full disclosure is the fourth general principle. According to this principle, all the necessary details relating to the financial statement should be disclosed. If not possible in the financial statement, you should disclose it in the notes to accounts. That is why in the annual report of companies, you will find there are some notes to accounts. Now come to the general assumptions. In the general assumptions, the first one is the going concern assumption. According to this assumption, it is assumed that the business will continue its operation and will not be closed or sold in the near future. It will go on with indefinite period. Monetary unit. For all the transactions, you should take one monetary unit. For example, if you are doing the transactions in India, the monetary unit will be INR. If you are doing a transactions in Saudi Arab, the monetary unit will be SAR, Saudi Arab Real. If you are doing transactions in USA, the monetary unit will be US dollar. So every country has its own currency and the transactions are done in the same currency. So whenever you make the records, you should use that currency as the monetary unit. C. Time period assumption. The life of a business can be divided into many time periods, such as it can be months, it can be years. Basically, an accounting period is taken to prepare the financial statement. 1 year is taken as the ideal time framework, as the time period for preparation of the financial statements. So every company at least have to prepare the financial statement once in a year. Business entity is the another assumption. According to this assumption, a business is accounted separately from other business and it is also separate from its owners. So owners and business are the two different things. This is the owner and this is his business. So owner should not be mixed with the business. That is why the amount invested into the business is considered as the liability of the business. If any amount is invested by the owner, that will become liability. So capital is the liability of the business. Whenever we make the transactions, we do not make the transactions from owner's point of view. We make the transactions from business point of view. All the preparation of financial statements are of the business. It is not of the owner. Now come to the next part of our discussion, that is forms of business entity or the forms of business organizations. There are three legal forms of business entity, basically sole proprietorship, partnership and corporation. Let us see in detail. Sole proprietorship is a business owned by one person. So in the sole proprietorship, there will be one person only. One person will be the owner. It is a separate entity for accounting purpose, but not a separate entity for legal purpose. So for legal purpose, the person and business will be considered as same. But for accounting purpose, as you know that separate entity is the assumption. So separate entity assumptions will be followed in all the forms of business entity in business organization. But from legal point of view, one cannot say that I will not pay because I am different and my business is different. In case of sole proprietorship, for the legal purpose, the person and the business will be same. Because if there is any claim upon the business, the person will have to pay. Let us see the advantage and disadvantage of such type of business. First advantage is that owner will get all the profits. So nobody is there to share the profits. All the profit will go to the owner. Second is that no business income is taxed, personal income is taxed, all the business income will be merged with the personal income of the owner. So his personal income will be taxed, there is not double taxation. High motivation because all the profit will go to one person, so he'll be highly motivated to work more and more. But there are some disadvantages. Unlimited liability. As I told you that from legal point of view, the person and business are not separate. So if there is any liability of the business, the person is involved there and the person's personal property can also be used for repayment of the liability. A person cannot say that no, my business is different and I am different, my property is different. No. Unlimited liability means a person's personal property is also at stake and his personal property can be used in order to pay the liabilities of the business. This is the meaning of unlimited liability. So this is the greatest disadvantage. Second disadvantage is that all losses and all liabilities are to be paid by that person. If all the profit goes to that person, so of course all losses will also go to that person. So there is no one else to share the losses. Now come to the second form of business organization, that is called partnership. Partnership is a business which is owned by two or more persons. They form a business, they run a business and are ready to share the profits or loss of the business. There can be a written agreement between the partners or it can be an oral agreement. The advantage and disadvantage are here. First one, the advantage, joint liability for tax and other obligations. So whatever tax is there upon the business, all the partners are liable for that. So there is a joint liability and joint liability for all the obligations of the business, for all the liabilities of the business. Secondly, more capital can be accumulated as compared to the sole proprietorship. In sole proprietorship, only one person is there. So the capital is invested by one person only. But in case of the partnership, two or more persons are there. So more capital can be accumulated. Now see the disadvantage. The disadvantage is first one, unlimited liability. The same disadvantage we have also seen in the sole proprietorship. So unlimited liability is also the disadvantage of the partnership business. Secondly, low motivation for each partner. Low motivation because all the profits will be shared. So anyone may not be so much excited, so much motivated to work hard. He will think that if he work hard, the business will earn a profit. So what is the advantage? The profit will not go to that person. It will be shared. That's why there may be a low motivation for each partners. Now come to the last form of business organization, that is corporation. Corporation is the biggest form of business organizations. A corporation is a business legally separate from its owners. In corporation, we find the limited liability and there is a separation of the ownership and the business. Ownership of all corporations is divided into small units that are called shares. So the capital of the corporation is divided into small parts. The small unit is called share. Every person who has invested the money into corporation by acquiring a share is the owner of the corporation. That is why in a corporation or in a company there are too many owners. There are large number of owners. A corporation gets its task done through managers. So managers are there in a corporation who takes the operation of the business. The advantage of corporation that is that it has a limited liability. There can be two types of corporation. One may be called C corporation and another is called the S corporation. The difference between C corporation and S corporation is tax. From tax point of view, we can have C corporation and S corporation. The owner of C corporation pays taxes on their corporate income as well as their personal income. So those who are having the C corporation, they will have to pay the income generated from their corporation as well as upon their personal income. But in case of S organization, this is not so. In case of S corporation, all the income of the S corporation will be merged with its personal income. So there will be one single tax that S corporation and its owner have to pay. But in case of C corporation, the owner of C corporation pays double tax. One on the income of the corporation and the second tax on his personal income. So this is the difference between C and S corporation. Now come to the act. There is an act which is created in the United States that is called SOX, Sarbanes Oxley Act. SOX. If the companies in United States have done something wrong, they have publicized accounting scandals or they have been indulged in some business abuse. So in order to check them, in order to respond to a number of publicized accounting standards like done by Enron, WorldCom, Fannie Mae, Xerox, etc., an act was passed in 2002 by the Congress in United States. The act is called Sarbanes Oxley Act. The act was created to check or to curb the financial abuses at the companies that issue stock to the public. The act requires that the public company apply both accounting oversight and stringent internal controls. What is the objective of this act and what is the result of this act? The desired objective of this act to include more transparency, more accountability and more truthfulness in the reporting transactions. It means there should be more transparency, means full disclosure principle should be adopted. Nothing should be concealed. Accountability means who will be responsible if there is any problem, if there is any fault. Truthfulness means the information should be true and fair so that information users can rely upon it. If these are not followed, which means failure to comply these, the company will have to pay the financial penalties. Thank you very much for watching. If you are not subscribed my channel, please subscribe it. And if you like the video, please hit the like button and share to your friends as much as possible. Goodbye. See you in the next video.